and give them advice also around what they need to continue growing both domestically and internationally. And I find that with some of my clients, sometimes it's neither myself or an equity investor that's really the solution. It could be a simple thing as making sure that the contract that you negotiate with your clients gives you the required cash flow so that you can keep growing. We also look a lot at making sure that companies can move money and receive money safely. So that's the treasury management services, and that they protect themselves against any foreign exchange risk as well. In terms of fundamentals for success, I think these are true regardless of who the investors are. You know, you'd be looking at making sure that the company has strong, innovative, proprietary technology, a business model that's scalable, a very strong management team and board of directors, the necessary financial support to reach market, a very strong understanding of their market and what they need to compete, and that ability to deliver the product in a way that the client wants it and is willing to pay for it. I've got a few more slides for those that want a more in-depth picture of what we could do in terms of shred loans, and also what we call the 5 C's of credit. It's what we use in any bank model basically to structure our transactions. If you want to make it available at the end, that's something we can definitely do.
Thank you, Natalie. I'm going to turn over to Ivan. Ivan is...
Sorry, may I make one?
Sure, go ahead.
I'm sorry, but I have to comment on this. And Natalie, that your slide on the sources of capital all the way from family, angels, and so on was excellent. Ask yourselves, in the totality of the money that is required to develop a drug, and remember the stem cell therapeutics financing of $33 million was for one molecule to take the molecule from preclinical to the end of phase 1 only, okay? 33 million. So ask yourselves, in the totality of the amount of money that's required to take a molecule into the commercialization pathway, not even to commercialize it, into the pathway, where does the money come from? And the answer is yes, angels, family, and VCs are critical in terms of putting together the first few $100,000, the first million or two. Approximately 80% of the money that finances life science companies in the United States comes from the public capital markets. Approximately 20% comes from VCs. The number changes. Sometimes it's 25%. 80%, ladies and gentlemen.
It's actually a good segue over to Ivan, because Ivan is an executive at ScarX Therapeutics, a small company, emerging company. So he's going to give us a bit of background on what he faces as an executive there on raising funds for the company, what has worked and what has not worked.
Sure. So how do I open that with that? So most things haven't worked, but maybe I can run through a couple of things. So, you know, obviously we're faced with a challenge here in Canada because we're Toronto-based. Our first approach really was to approach angels and VCs here in the community. I think first off, you know, that's just a challenge for therapeutics. I get the sentiment that angels aren't that terribly excited about the therapeutic business model, the type of patients and the dilution that they will have to endure. And so I really don't think the angels are really there for a therapeutic opportunity. It may be different for a med device type play. Leaving you to the VCs, which I've already commented on, and so very quickly, you either get to the second meeting with one of those 5 groups or not, and then you're left with really approach the United States. Before I go to that experience, you know, we tried to get creative in the sense that, and I think we might touch on it a little later on about in-kind type investment. So starting to talk to partners in exchange for jurisdiction rights, things like that, where they will do some of the work either pro bono or at a major discount in exchange for those rights. And so that's something that we did do early on. We did it with a China-based pharmaceutical company. And I would actually throw that in the bucket of things that didn't work. In part because we're a virtual stage company, And I think what we didn't quite realize is how difficult it is to work with a large organization. The manpower that you need to be on top of that from a project management perspective, if you start adding time zones and language barriers and so on, was all consuming. And really by the end of it, somewhat ineffective. And we found that it's just more efficient to go there and hunt for money and actually do it right here in North America. So, you know, we attempted it. It didn't work for us. And at the same time, when you're early, what you don't maybe realize is that your chances are is that your business plan is going to change a little bit. So if you lock into some partnership or some sort of deal with an organization, you kind of lock yourself into that business plan, and so it doesn't give you a lot of flexibility as to how to move from there. And so following that, we really went to the States and spent a lot of time talking to VCs down there. I would say that thus far we really have had the most traction down there. They just seem to be risk tolerant. They understand it. They've got the depth. They've seen 10 deals like you. They get to the point pretty quick. So.
Thank you, Ivan. Just kind of expanding on the topic of different sources of capital or indirect sources of capital, I'm going to ask David now to speak to this topic. I understand Avid Biologics entered into a partnership with the NRC to develop 3 new antibody drug conjugates. Can you provide some insight on this program and other sources of indirect capital?
Thank you. And let's not omit the direct capital, first of all. The SHRED program for private companies is, as everybody knows in this room, about the finest anywhere around the world. It's absolutely exceptional. And IRAP is also a terrific source, the NRC IRAP. But again, $25 million, my guess, incidentally, is a number of the $72 million that IRAP puts out probably goes to the life sciences. The Southern Ontario program from the federal government from last year was just a waste of time. From the life sciences point of view, I can't think that maybe more than $1 million went in. Mars Innovation is a great source, but small. But Mars does a great job, but it's U of T focused only, so problematical. YM Biosciences has worked for years with the National Research Council, originally as a service provider, doing a scale-up of monoclonal antibody manufacturing capabilities, which we then subsequently transferred, and we paid them a fee for that. But since the Harper government changed the mandate of NRC and John McDougall took over, Julie Ducharme and Maureen O'Connor have done a brilliant job in terms of partnering with industry and ensuring that the National Research Council, certainly in biologics, and I'm not sure about small molecules where I gather a bit of sense of perhaps competition with the private sector, but there's no competition in biologics because there's nowhere else to go in Canada at this point in time. And they are magnificent. First of all, the depth of their science is outstanding. Their in-kind contribution is, I don't know exactly how they measure it and what their costs are, but probably costs that we couldn't afford as Avid Biologics, as a startup company, if we were doing it on our own. Definitely couldn't. And enormously supportive and full of ideas and full of innovation. And by innovation, I don't mean what politicians mean, which they mean invention, but actual innovation. So let me strongly suggest John McDougall, Julie Ducharme, and Maureen O'Connor, National Research Council, as your partner in development.
Tracy, can I just add to
Yes,
some
please.
of some of the alternative sources of financing as well? Obviously, outside of the traditional routes, you don't want to necessarily give up on the pharma and biotech communities, because everyone knows what the pharma sector has been through over the last couple of decades, and they're always looking to supplement their in-house R&D through outsourcing. So they're always looking to do academic collaborations at the research level, looking at in-licensing, M&A. But they also have corporate venture arms, which sometimes are difficult to get into. But if you do have something that's transformative, something that's disruptive technology, they are certainly a captive audience, and they will look at investing in those. The only other emerging source of funding I would also add is patient advocacy groups, such as disease-specific groups like the Michael J. Fox Foundation or the Juvenile Diabetes Research Foundation. There are many others as well. Do take some time to actually get into and make a relationship, but if you've got something specific that addresses those individual diseases, that's certainly a worthwhile venture. And the last thing is venture philanthropy, obviously more in the US than here. The example that always comes to mind is the Gates Foundation for that focus on infectious disease and vaccines. Just want to throw that out there as well.
Okay, David.
I omitted to say that the YM table is at the far end of the room. Welcome. At YM, the model that we used was to do regional licenses. So when we were developing a monoclonal antibody, it was, from an international point of view, effectively just in phase 1, although we had it in proof of principle phase 2. But we licensed the Japanese territory to Daiichi Sankyo for $20-something million. Sean Thompson did that. We licensed Korea. We licensed the largest public Southeast Asian pharmaceutical company for Southeast Asia, Singapore, and all those areas for a number of millions of dollars. And we licensed out Europe to another developer and maintained for ourselves the largest market in the world, being the U.S., Canada, U.S. and Canada. So regional licenses are really worth thinking about and pursuing, to Ivan's point.
Thank you. And Ivan, did you have anything to add from kind of the preclinical stage?
Yeah, so, if the topic is drifting to just sources of capital for early stage, here locally, there's a number that I don't think have been mentioned so far. So at least for us, the OCE, the Ontario Centres of Excellence, the Market Readiness Program, I have to say is top notch. They play in a space where absolutely nobody does. In the sense that you are super early, are proof of concept, and they're there. We've touched on Mars Innovation. I can't help but emphasize their role, specifically if your technologies are arising from U of T or any of the affiliated hospitals. You have IEF, the Investment Accelerator Fund based out of Mars. So they will invest as a syndicate partner, but they're limited in the sense that they won't lead the deal. From a cancer, if you fall in the cancer, OICR IPDC program, again, that nice $500,000 type chunks of money that can really get you closer to your first angel or your VC round. FedDev, an excellent program matching 1 to 2, NRC, IRAP, and really more recently though, BioCap program has come out really with a program that really offers mentorship and introductions to VCs and angels and so on.
That's great, some helpful tips. I think we would be remiss today if we spoke about access to capital and didn't touch on crowdfunding. It's actually been left to me because of the current state of affairs in the legal market with respect to crowdfunding. For those of you who don't know what crowdfunding is, I'm sure you've heard about it. It's definitely a buzzword. It's the concept of funding your enterprise or your project through accessing small amounts of money from a large group of people you don't know well. It's typically done through an internet portal in order to access that crowd. It can be done in many different ways, and some of them are currently valid and legal in Canada. They may have legal implications, but there's ways of doing it. You could do reward-based crowdfunding. Sometimes people will, produce a movie and ask people to donate money towards it and get their names in the credit. It's a reward for them. There's donation-based crowdfunding where people donate to a cause. Sunnybrook has a website right now where you can go on and donate to the specific research project that you want to support. Great initiatives. Presumably, if you could get donations or reward-based crowdfunding, you would be doing that. You wouldn't necessarily be here today. I think the one that's of most interest and that's still in a little bit of legal flux here in Ontario is true equity crowdfunding, and that's the raising of small amounts of capital through the exchange of securities. The OSC, somewhat following on what we're seeing in the United States, has issued last year, actually probably in December 2012, issued a consultation paper on the topic. It's available on the OSC website, and I can certainly give it to people if you'd like, but it provides their perspective on crowdfunding, what they thought might be an appropriate model to use in Ontario. They sought feedback. Many people commented on the paper, and they had kind of roundtables and surveys associated with that to see which direction they should go. Fortunately, in August, the OSC indicated in a positive way that they do intend to kind of pursue this in a greater way, and have asked staff at the OSC to start drafting some legislation. So that's a positive step as far as a different source of capital. I do want to caution you, though, that in their initial concept, they had some limits with respect to this. Obviously, they're concerned about potential exposure to investors who may not have that much advice with respect to their investments. So that the most that an issuer could raise in 1 year, this is just under the draft, was 1.5 million. So this is not going to provide a company with a lot of capital in any given year. The most an investor could invest in a single investment would be $2,500. And each investor could invest more than $10,000 in a year under the kind of crowdfunding proposal. So these are small amounts of money and a total cap of $1.5 million per year. So although crowdfunding might be able to help you in some respects, it may not be that, as you're developing your business and need greater sums of money, it may not be that helpful. There are some definite pros to it. You can get access to money. You can probably fund some projects that you wouldn't ordinarily be able to fund. You can engage people if your product is interesting to them. They can start to develop that word of mouth for you. There's some definite positives. There's definite cons as well. You have to be careful if you want to engage in crowdfunding. You'll start to create a huge shareholder base, which you are accountable to. You'll have to report to. And when the VC or angels or whoever you want to come and fund your enterprise at the next level, they may not be thrilled to have that number of shareholders. So as I said, that's just kind of a high-level overview. It's not yet law. It's not even in draft law yet, so it's a ways away. We're lagging a bit behind the U.S. The U.S. looks like they've got draft legislation that has been out for comment, so hopefully we'll see what's happening in the United States in the next year, and Ontario to follow after that. Okay, so moving on, we've discussed this a couple of times today, or at least hinted that we would be discussing this. I receive a lot of questions in my practice on going public, when to go public, how to go public, and most people want to go public. I thought we would start with having Michael discuss a little bit about the capital pool program at the Toronto TSX Venture Exchange and the qualifying transactions that might be of interest to some companies in the room.
Sure, thanks Tracy. Just as I've been sort of reflecting on what we've heard so far through the panel discussion, there's kind of 2 or 3 themes that have started to emerge for me of note. First of all, it's hard to raise money. I think we've heard that a number of times. Secondly, as Tracy just said, and as we've heard others say, getting to the public markets can be a really effective tool to raise money, to have access to different structures for raising capital, be it the private placements that we heard talked about or otherwise. And thirdly, because of the lack of depth in the Canadian market, getting access to US investors is really important as well. And so you may think, well, how does TSX or TSX Venture kind of meet all of those objectives? Certainly we can help in terms of going public, but how does it help getting access to US investors? And I think what a number of companies have discovered is that by listing on TSX or TSX Venture, they can actually use it as the important stepping stone to getting access to the US investors. And close to 40% of the companies that are listed on TSX are actually dual listed. So in other words, they have added a listing on New York or NASDAQ to help reinforce that access to capital. So if you take the view that you do want to go public and you decide that maybe Canada is the right place to start for that, how do you do it? And as you might have remembered from my slides, I showed that 8 of the 10 transactions that we've seen in the last year for companies going public have been affected by this structure called a capital pool company, or sometimes called a qualifying transaction. So let me just briefly explain what that is and how it works. And I'm actually going to start by just giving you some context that this isn't some crazy scheme that we've come up with, but in fact something that's had a long track record in history. The program's been in place for about 25 years, and over that time about 2,500 companies have actually used the structure to go public. So there's definitely a track record here. And out of interest, some of Canada's biggest companies actually began their lives using this structure. The biggest one's an $8 or $9 billion mining company called Silver Wheaton. and one of the largest IPOs or going public transactions last year in the life sciences space. A company called Concordia Healthcare went public in this route. So it's certainly been a useful technique. Okay, what is it? Basically, there's 2 steps involved in these CPC transactions that allow companies to go public. The first step does not actually involve the company in question, but it's important to understand what the step is. The first step involves the creation of the capital pool company. The capital pool company is a publicly traded shell company that has nothing but cash in it. And it's created by a number of seed investors putting up some of their own capital, and then a full-on public offering of that entity. And to be clear, that entity is set up with one purpose only. It is to hold cash and to find an operating business to combine with. So when step 1 is completed, there is an entity listed on TSX Venture Exchange that has cash and an ambition, and that's it. And that cash is anywhere from about $1 million to a maximum of 5. They're typically around $1 million in cash. So as I said, that step actually does not involve any of the operating companies in the room, but it's the necessary first step. The second step is where you all come involved, because these CPCs, once they're set up, once they have their cash in place and once they're trading, have got 24 months to find what is called a qualifying transaction, which is a combination with an operating business like yourselves. They have 24 months to effect that transaction, and when that transaction is executed, effectively what's happening is a reverse takeover. That public company is, quote unquote, buying the life sciences company for shares, but because of the relative valuations, what ends up happening is the public company is issuing so many shares that the life sciences company ends up almost all the time as the controlling entity, typically with sort of 80 or 90% of the shares, but they have gone public in the process. So the result is the life sciences company goes public through this structure, ends up with the benefits and drawbacks that we're going to be talking about in subsequent conversations of being a public company, but has affected it typically a little bit more quickly and a little bit more cheaply than the traditional IPO route. The end result after those 2 steps is the same as if you'd taken the company public in the traditional sense. And what I mean by that is the end result is you are a public company with all of the obligations and benefits of being a public company.
Thank you. So then I do think we should discuss when is an ideal time to consider going public, and what are the pros and cons of that. Maybe I'll start with Prakash. You want to lead us on?
Sure. So that's always a difficult question, and it's hard to make general statements, as it's highly an individual company and individual management decision. In my view, there's really 2 primary reasons that private companies want to go public, and number 1 is that they're totally tapped out of private money. There's nothing else to be found, and they're forced to tap into the public markets. The second reason is that one or more of their private investors is pushing them for an exit, and the only way they can do that is through a public vehicle. So those are the 2 primary reasons on why companies tend to go public. But I really want to emphasize that as much as it's a great idea to go public to access greater capital pools, you want to make sure that you really have exhausted all of the private sources of funding, as well as some of the alternative sources of funding that have come up through the commentary on the panel. There are a lot of significant cons that a lot of people don't think about before they actually get into the process. There's a lot of minimum requirements to go public, and Michael probably has a great laundry list of those, but obviously starting from just the fundamentals of your organization, from the people that work there, the board members, looking at your financial statements and making sure they're all up to date, making sure you have minimum amounts of working capital, and of course making sure that your signs, your IP, and your development plan are really well thought out and easily communicated to potential investors, because there will definitely be an extensive amount of due diligence done by scientists and lawyers and whatnot before you go public. Other restrictions are looking at minimum numbers of shareholders you need to have, with certain numbers of shares at each each owns, so their liquidity requirements by the TSX. That Michael can certainly speak about. And I think the other really important thing is to think about the amount of commitment it takes. And the reason I say that is that a lot of small companies are essentially founder-driven. So the CEO is the founder and the chief scientist, and he or she does everything. And can you take on the additional responsibilities to go public? And if you can answer that, or you have somebody else who can help you with that process, then certainly it's certainly a worthy consideration. Remember that once you're public, that you're no longer able to keep things within your organization. Investors and regulators expect timely disclosure of your financials, of your progress you're making on the clinical development front, and you're essentially going from playing hockey in the minor leagues to suddenly playing in the NHL. Everyone's going to be watching you and what you do and how you perform. Tracy, do you want me to go into some of the pros and cons, or you want to leave that to other people?
A couple more.
I think everyone knows that the public markets, as David Allen has already rightly said, 75 to 80% of the financing comes from the public market, so you definitely have greater access to larger pools of capital. It serves as an exit vehicle for early stage investors, whether it be your angels, your high net worth investors, or even founders after a certain lockup period. You're definitely able to tap into different financing options, and you're no longer held captive by your VCs as well. The other nice thing is that when you're a public company, you can then actually issue options that are actually worth something, and you can use that to retain employees and attract greater talent. And bottom line is you get greater recognition and exposure. That can itself be a double-edged sword. Greater exposure in the public markets means that if you have a little hiccup in your clinical development plan, your stock can get crushed. Whereas when you're a private company, a lot of that information stays confidential and it doesn't have the same level of impact on your valuation. So remember that it can be good and bad, and you have to really be careful of that. On the con side, I think there's a significant amount of cost and time effort. And on the time effort, I'm really referring to the CEO or founder and how much commitment on your time it does take. It can be a real distraction for founder scientists when they suddenly have to talk to investors every day and actually have to understand about the financials of the company. And these are things that not everyone's really ready for. So you have to make sure you are ready, or make sure that you actually hire people to help you with that. And the last thing I think is that once you go public, many small public companies end up becoming orphans on exchanges. And this tends to happen more in the US than it is here, primarily because you are now a small fish in a very big pond. And unless you have followers who are active in trading your stock, and you have banks who actually write research coverage on your stock, it's difficult to stay top of mind with investors and to garner that attention. So those are
Thanks so much.
some of the things.
Richard, go ahead.
Ask a quick question. Just as you were speaking, I just had a quick question. So there's been the comment around the 80% of capital in biopharma is coming from, public financings, and I'm thinking that maybe that's not truly representative of maybe the early stage situation. As we saw from Michael, going public and all the work that is involved, you have to ask yourself, I guess, is it worth it for the $1 million or $2 million financings that you're really likely to achieve? And so I was wondering maybe if somebody wanted to comment on that.
I think David wants to say something.
No, surely not.
Go ahead.
I can't comment on the $1 or $2 million thing. To Prakash's caution, all his points are absolutely right. And the biggest, anybody can go public, but you have to have a will and commitment that is unparalleled. And you have to be prepared to, as Prakash pointed out, to never be going home again, because it's not going to happen. And what keeps access to the biggest component of access to capital is time and resilience. and you just never give up. There are 2,650 private biotech companies in the United States. There are about 300 funds that are biotech-specific investors. So if you divide 2,568 into 300 or the other way around, you know how many calls each and every one of those analysts and portfolio managers are getting every day. If you are not in front of OrbiMed and Baker Brothers and every other one of those big names across the United States, every quarter, you're going to be one of those orphans and you're going to die. And nobody's going to pay any attention to you. So you spend your life on the road. And at YM Biosciences, we raised $380 million over 15 years. All of it by my spending my time on the road with a team that was equally committed. So it's the skills you can buy, but the commitment you can't. Sorry, let me add. Ivan said that there are 5 VCs in Canada. I think that's probably correct. There is more money on any one floor of 153 East 53rd Street, which is the Citibank building. There is more money on any one floor than there is in all of Canada for investment in the life sciences. And the reason for that is each of those floors